This class is financial management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. Today we will cover the first half of Chapter 7, Analysis of Financial Statements, from the excellent text by Brigham and Davis, Intermediate Financial Management. Today's topics will include ratio analysis, the DuPont system, the effects of improving ratios, the limitations of how to use ratio analysis, and other qualitative factors not reflected in ratio analysis. Ratios can be used for many things, such as determining the net operating profit after taxes and the required investment in operating capital, both of which will affect the free cash flow. They can also be used to look at how the market perceives a company to determine how valuable they think it is. Ratios facilitate comparisons of one company over time, or they can be used across industries, or they can be used within a given industry to look at one company versus other companies. Ratios are used by lenders to determine the creditworthiness of a company, or for that matter, an individual looking for a home loan. They're also used by stockholders to estimate future cash flows and risk, things like price to earnings ratios. And they're used by managers to identify areas of weakness and strength within a company. We will start by looking at our hypothetical firm and its income statement here from 2015 to the estimates of 2016, where we see sales are going up, cost of goods sold except depreciation is going up, other expenses are going down, depreciation is going up, and overall the total operating costs for this company are increasing rather drastically, such that earnings before interest and taxes are going down significantly. The interest expense in this case is also going down, so that the earnings before tax for the company are going from a negative up to a positive. The taxes last year were negative because the company lost money. This year they will be paying taxes of $169.56. Last year their net income was negative. This year, their net income is positive. Looking at the balance sheet for the same company, their cash on hand is increasing. They are having more short-term investments, so also more liquidity from not just having cash, but being able to buy treasury bills or commercial paper in other companies. Their accounts receivable is going up. They're selling more stuff probably, and other people are owing them more money. And their inventories is increasing so that their total assets have gone up drastically. Their net fixed assets, on the other hand, have gone down, so their total assets overall have increased. This could be a positive, this could be a negative. It depends on whether all of these current assets they have are being used effectively. On the liabilities and equity side on the balance sheet, the accounts payable is going up as they have expanded. They are owing more people more money for stuff they are buying. On the other hand, they have paid down notes payable. They have less debt. Their accruals have gone up, which probably means they owe more in taxes and they owe more to 401k plans and health insurance plans for their employees, so they have a higher employee base. But overall, their total current liabilities have gone down. Also, their long-term debt has gone down. But they have financed this, it looks like, by issuing a lot more common stock. They, on the other hand, have been making money with that common stock. Their retained earnings has gone up. So their total equity has tripled, gone up substantially. Their total liabilities and equity has also significantly increased. Other data we have for the company, the stock price has over doubled, so the company is being perceived positively in the market, even though it's issued a lot more shares of stock, increased the shares outstanding from 100,000 to 250,000, as they've gone from a company that lost money in 2015 to one that's estimated to make money in 2016. They're also paying out a higher dividend, gone from 11 cents per share to 22 cents per share, and their book value per share has gone up significantly. Lease payments have stayed the same, and their tax rate has stayed the same. The tax rate is an estimate of the federal plus state income taxes, probably a little bit lower today since Trump has cut corporate income taxes. The first question we will ask when looking at ratios is, can the company meet its short-term obligations using the resources it is currently on hand? And these would be liquidity ratios. The first liquidity ratios are the current ratio, which is current assets over current liabilities, and the quick ratio, which is current assets minus inventories on current liabilities. The current ratio is an estimate of if the company has to, can it liquidate its current assets and pay off its current liabilities. And the second one, the quick ratio, is can it liquidate its current assets other than inventories and pay off its current liabilities. Generally, if it liquidates its inventories too quickly, it's going to either be going out of business or making some sort of a strategic change. So the current ratio is reasonably high at 2.58, not bad. The quick ratio, 0.93, not too bad, although these things vary a lot from industry to industry, and the appropriate thing is to not use them in isolation, but look at a trend and compare them to the industry average. So if we look at the current ratio for this company over time, it went down from 14 to 15 back up to 16. It is below the industry average, and the quick ratio did the same thing. It's still below the industry average. Overall, they are expected to improve, but they are not as good as the industry average. So this company has a slightly higher risk in paying its short-term debt than the industry average. They should therefore have to pay a slightly higher interest on their commercial paper or their short-term bank loans than other companies in their industry. How about asset management ratios? How effectively does the firm use its assets? How much does the firm have tied up in assets for each dollar in sales? As we look at things like just-in-time systems, you really would like to keep your assets as low as possible relative to sales, but you don't have to worry about things like employee strikes or, as happened during the pandemic, not being able to get things shipped. Next, we will look at the inventory turnover ratio versus the industry average. The inventory turnover ratio can be calculated as the cost of goods sold plus the depreciation of those goods divided by the inventories on hand. So we're looking at how quickly a company turns over its inventories. In a just-in-time system, this would be very high and the company would keep very low inventories. This would be particularly important in something like the tech industry, where the value of computer chips drops quickly. Going back historically, this is an example of how Dell Computer beat out Compaq. They both produced similar computer systems, but Dell had a very low inventory turnover. It actually got the people buying its product to pay for it before it paid for its suppliers. Compaq, on the other hand, let its inventory sit in warehouses and depreciate, and this made Dell a far more profitable company. In our example, we take cost of goods sold of $5,800 plus the depreciation of those of $120. We divide that by the inventories of $1,716 and get 3.45. We see that the inventory turnover is below the industry average and in fact is going down, which is the opposite direction of what we want, indicating that for this company, control of inventories is probably not going well. There are, of course, some companies, like, for example, Scotch companies where aging the product over time is important, and a just-in-time system and a high inventory turnover ratio would not work. So as we can see, summarizing, inventory turnover is below the industry average. The firm might have old inventory, or its control might be poor, and no improvement in the inventory turnover ratio is currently forecasted. Another ratio to look at would be days sales outstanding, or the average number of days from sale until cash is received, and this is cash receivable divided by the average sales per day, or the total sales divided by 365. In this case, that is accounts receivable of 878 divided by 7,036 divided by 365, or 45.5 days, a rather long time to wait and get paid. Some industries, you get paid immediately, cash for produce, for example. Other industries, like the American healthcare system, you could wait for months to get paid as you go through a cycle of seeing a customer, then getting maybe a copay, but then the customer's insurance gets billed, the insurance kicks it back, the customer complains about being billed more, maybe the billing codes are wrong, this goes on, and then you collect from the customer, and in many cases, of course, in U.S. healthcare, end up suing the customer, and also, of course, you collect from the federal government. So that industry has a very high DSO. In many other countries, you have cash payment for health insurance, which is cheaper for the patient and generally works better. So how do we appraise DSO? Again, it varies from industry to industry. In this case, the firm collects too slowly and its situation is getting worse, because we can see the DSO keeps increasing and it is above the industry average. So they have a poor credit policy and probably a lot of outstanding bills that will never get paid. Other ratios to look at: fixed asset and total asset turnover ratios. Again, what you want is high sales but low assets. So the fixed asset turnover ratio is sales over net fixed assets. In this case, 7,036 divided by 837 gives us 841. The total asset turnover is the sales over all of the assets, fixed plus current, and that is 7,036 over 3517 gives us 2. And to see whether these are good or not, again, you have to compare them over time and with the industry average. So the fixed asset turnover, it has been high at 10 in 2014, gone down in 2015, and now gone back up at 8.4. It is above the industry average, so they are using their fixed assets effectively. Commonly, companies with big factories will do things, for example, like run those factories 24 hours a day and have 3 shifts, which is a very effective way of using their fixed assets. There are countries, perhaps like France, where due to labor laws this may be illegal, although commonly in Europe, even though they have labor laws limiting the number and times of hours employees can work, Germany, for example, exempts the auto industry from this. The total asset turnover is not up to the industry average, and it's caused by excessive current assets, the problems that we noted with inventories, etc. So this company is efficient at managing its fixed assets, but not its current assets. How about debt management ratios? Does the company have too much debt? Can the company's earnings meet its debt servicing requirements? So a total debt ratio would be total debt over total assets. In this case, 300 plus 500, that would be notes plus long-term debt over total assets, gives us 22.7%. Another leverage ratio is liabilities to the assets ratio. This is total liabilities over total assets. To get the total liabilities, we take the current liabilities of 1039.8 and add the long-term debt of 500. This leaves out everything but the equity on the liabilities and equity sheet, and divide that by total assets of 3,517, and we get 43.8%. Again, this varies drastically from industry to industry. Therefore, we have to do an industry comparison to know whether it is good or not. The times interest earned ratio is a measurement of the ability of a company or individual to pay their interest expense. It is earnings before interest and taxes over the interest expense, or in this case 502.6 divided by 80, or 6.3. This is used by analysts to see how high the interest rate on the debt for companies should be, or what their debt rating should be, AAA, BBB, etc. It is also used by banks to determine whether or not they should give you a car loan or a home loan, and what the appropriate interest rate to charge you for that loan is. EBITDA coverage ratio is an even broader measurement of the ability of a company to pay its monthly financing expenses. It is earnings before interest and taxes, plus depreciation and amortization, plus lease payments. So basically all of the money available to pay the items at the bottom, which are interest expense plus lease payments plus loan payments. In this case, an earnings before interest and taxes of 502.6, plus depreciation and amortization, since that is a non-cash flow item, of 120, plus the lease payments of 40, divided by now the interest expense of 80 plus the lease payments of 40, giving us 5.5 for this company. If we look at these debt management ratios over time and compare them with the industry average, you can see that in 2014 and 15, this company has too much debt compared to the industry average, but it is projected in 2016 to get in a much better debt position. With the total liabilities over total assets, you see the same trend. With TIE, you see that in 2015, they were in very bad shape. They went from 3.3 on TIE down to 0.1, but they are projected to go up to 6.3 in 2016. And for the EC, again, it got very bad in 2015, but it is projected to improve, although still be below the industry average. So the recapitalization has improved the situation, but the company is still not doing great. Other ratios we will look at include profitability ratios, like what is a company's rate of return on its sales or assets, and we will answer these questions in the next half of this video. I thank you for watching this video.